Let's see what Adam Parker has to say about that. Adam is Morgan Stanley's U.S. equity strategist, one of 14 that we survey for market outlooks here at Bloomberg. Adam, good to have you here on the close on Street Smart. I mean, what do you make kind of the trade today? I mean, Europe hasn't gone away. That's still a problem. Certainly the U.S. fiscal situation isn't a problem. Even some bad news from Best Buy, which plays into the consumer. That's not dragging down the trade, and certainly not the tech trade today.
Well, our view, our differentiated call at Morgan Stanley all year has been that the market multiple, what you pay for the earnings is going to contract because you're going to worry about sustainability. You're going to worry about Europe. You're going to worry about U.S. deficit debt and potentially about emerging markets. And those things are going to episodically look better and worse, but the trend's going to be a downtrend. So we continue to believe market multiple contraction is likely, and that's a core part of our call here.
Adam, hang on for a second. We talk about companies having so much cash on hand, and that includes some of the tech names and what they're going to do with that cash. And we're finding out what one is going to do, Julie. That is Dell.
Dell is going to give some money back to its shareholders in the form of a stock repurchase. It's authorized $5 billion for that stock repurchase. It's already adding to about $2.16 billion that had been remaining for prior authorizations at the end of the second fiscal quarter here. So again, the company is announcing this stock buyback. The company says our efforts to streamline our operations, reduce costs, has resulted in outstanding cash flow from operations. And that means that we've been able to do more things like research and development, capital expenditures, acquisitions, and now the company also buying back shares. The shares, incidentally, are rising on this news that they are increasing this buyback authorization. Adam Parker, I know you're looking at the fundamentals here, you're looking at earnings, you're looking at multiples, but where does cash sort of fit into the equation? Because we do have all these companies with a lot of cash, and a lot of them have been using it for buybacks and for dividend increases.
We look really carefully at capital use and its consequences. As you alluded to, there's a number of things that companies can do. They can buy back stock or increase their dividend or do deals. Our belief is that on the margin, you'll see a good M&A cycle and you'll see dividend growth. The S&P's dividend yield is still way below the long-term average. And if you want to argue that equities are attractive versus other asset classes, you probably want to lead with the argument that the dividend's attractive. And the way the dividend goes higher is payout ratios go up and the stock market goes down. And I think that's probably the base case.
And this is an issue we're going to talk about when it relates to Microsoft a little bit later on Street Smart. But Adam, let me ask you, we do know companies are flush with cash at this point, but we're not seeing them out there aggressively hiring workers. And that's really been problematic to our economy. What's going to get them moving at this point? Or are we just going to see them continue to do buybacks, increase dividends at this point to help out shareholders?
I think they'll spend when they see there's an opportunity to spend. The question is, do they need to? So utilization levels rose in the factories, and they were very prudent in the last down cycle. The challenge will be how can they get margins continuing to expand from these levels. The biggest problem in the market, in my mind, is not only will the multiple contract, but the margin expectations that are embedded in the analyst views are too optimistic. I think the estimates have to come down, and then you can start worrying about deploying it more productively. And I don't think that's the base case for the rest of this year. You have to have the analysts reset the estimates, right, and then maybe it'll set up better for next year.
You talk about earnings expectations maybe being too optimistic at this point. Someone else who's not feeling so great about the economy is former Fed Chairman Alan Greenspan. He's got some concerns. He testified today before a Senate panel up on Capitol Hill. Listen up, everyone.
We are in a period of very sluggish economic activity. There seems to be no real potential for changing that materially. And the revenues we're going to engender, irrespective of the tax code, are going to be much less than I think is currently being projected.
Adam, how worried are you about the economic environment? Whether or not we go back into recession, maybe doesn't matter. If it feels like a recession, that could be bad enough.
Well, we wrote a note at Morgan Stanley last week called "It Just Doesn't Matter." And we wrote that in response to investor questions, which were all of that ilk. Is it a recession or not? I think people were wondering, hey, if it's a recession, I'm selling. If it's not, I'm buying. And I was trying to tell people, look, it doesn't matter. If there's a very high probability it's not going to be great, whether it's 1% plus or minus 1%, doesn't matter. What matters is your positioning should be defensive, focused on above average yield, focused on high quality. And that leads to some of our sector recommendations, which tend to be more defensive, things like healthcare and utilities. where we think they just have a better chance to achieve the estimates in the second half of the year. So I'm not sure it really matters semantically, because we might not know for 9 months if we're in a recession today. I think some of the experts don't even know if we're in a recession today. So I think it's more about how to position prudently in the second half.
Adam, it's Julie again. You know, we get a lot of bulls on the program here who say even if they're pessimistic on what happens in the overall economy, recession or not, they're still optimistic on earnings. And one of the things they point to is the position of the balance sheets, because going through a recession, so many companies have really pared down. And for that reason, they say earnings are still going to be able to be okay. I'm curious what your response is to that argument.
Well, the balance sheet and the income statement aren't totally related. I do think that you have a better scenario in terms of the bear case this time than '08. And Morgan Stanley, we've written a lot about that, well, it might not be great, it's not '08. And I don't think the number of companies that went bankrupt last time could go bankrupt this time. Cash balances are higher. So I think that is a relative positive in terms of floor valuation. I think we'd be more interested in the S&P and probably more bullish with what we know now, around 1,000 on the S&P. But so there's not the downside we saw last time. I think that's right. But it doesn't necessarily mean that people are going to pay for the cash, that you're generating interest income off it. I think it's a little bit maybe just, it's not complete to just say there's high cash. The earnings themselves are going to be limited by a lot of factors in the second half of the year that were beneficiary in the last couple of years. Things like a currency, which really helped and won't help as much, or labor productivity, or depreciation. There's a number of factors that fueled margins that'll probably become less tailwinds or even headwinds later in the year.
Adam, it just doesn't matter is another Strange Brew reference, right? Because we had another one earlier in the show, and it's weird to have two.
Meatballs,
no,
it's
not
the movie Meatballs, actually.
I thought it was a Strange Brew reference. Listen, you're saying the downside risk isn't as bad as people think, but you think the upside risk isn't there either, right? Because you're underweight industrials and consumer discretionary. We were just talking about the fact that the top quintile does 50% of the consumer spending, and they buy more expensive stuff. You don't think they're going to be out there spending?
Well, we do think that the upper-end consumer will be better. I think the challenge is what's in the price. I mean, the estimates accelerate, and so therefore estimate achievability. Think about what happened during July earnings season. The rewards for beating estimates were far smaller than the penalties for missing. So now you look at October and you say, well, wait a minute, do I want to own companies where the estimates accelerate a lot? And to me, that means you have to be cautious on things where the mid-range consumers focus, restaurants, mid-tier department stores, select apparel, et cetera, where I think estimate achievability is going to be a big issue, and I think making a big procyclical bet won't be prudent.
Hey, one thing we notice is that a lot of folks come on and they talk about the big cap names, that's where investors should be. Adam, you've been looking at small caps versus big caps, and what you're noticing is those smaller names, they're falling behind the bigger caps that are out there in the S&P 500.
Yeah, they sure are. And in a tough economic environment, you expect small caps to lag the large caps. If you take a look specifically year to date, the gap now is about 5 percentage points. You see how closely they've tracked, and all of a sudden over the past couple of months, that's widened out. So, Adam, my question to you, and by the way, it's kind of nice to have two Adams on the show simultaneously. My question to you, Adam, is has that gap widened out enough that you can justify some of the small cap names, or just stay away?
In classic when risk rises, risk aversion rises, when people get more afraid, they tend to want to own the mega caps. They're more liquid, they have more defensible characteristics, they have better estimate achievability. And my view is that risk aversion is going to remain high for the remainder of the year, and I tend to think mega caps are still undervalued relative to the broader market. So I still like the mega caps here generally.
All right, hey, Adam, thanks so much for joining us. I also appreciate having two Adams. Actually, this is Matt, but two Adams is always good. Adam Parker there, U.S. equity strategist, Morgan Stanley.